All right, we're live.
We're
How's
live?
everyone? Yeah.
Very good, very good. Hi guys, my name is Joseph E from Residential Projects Australia. Once again, I have James McCauley with me, and this is our Q&A session where you can ask us any questions live. But if you don't have the questions or you're maybe shy to ask us questions, we do get a lot of questions sent through Facebook and direct emails and the general questions that we get on a week-to-week basis.
Yep.
And then we answer them questions for you. But you can always jump online and punch in a question, and we'll be happy to answer it if we've got the time or if we pick it up while we're looking. So we'll go from there. So I'll hand it over to James. James normally throws the questions at me. He gets them all, and
so
we can answer them.
Yeah, I've got no questions. So that's it for today. So thanks guys for listening in. So I think a few questions today. Well, I think main thing is the news. So the RBA has finally dropped their rates by 2.5 or 25 basis points, right, down to 1.25%, which is the lowest that I think
it's been in 3 years. Well, it's the lowest in history.
Yep.
But it's the first drop in the last 3 years.
Yep.
And that's really positive news, I guess, for investors, owner occupiers out there that are really wanting to get back into the marketplace.
Yep.
Considering that also that there could be even further drops, up to even 3 to 4 drops, or 3 drops over the next 12 months.
Yep.
Bringing the cash rate down to almost zero.
Yeah. So it'd be nearly nothing, and you can see that it hasn't dropped for 3 years now.
Yes.
But how much has it changed in 3 years?
Yeah.
Markets have gone up. We reached the high, like a really high peak. Then it's gone back down. It's correcting itself, and now it's starting to kind of stabilize. Hopefully, go up. Don't want it to go up too much. But with that, you can see that they've held it for so long. Now they're finally saying, okay, well, let's drop it a little bit more. And what do you think that'll mean?
Okay, well, the first thing I'd say is, as I said, from the investor's perspective, interest rates, well, we're hoping that the banks or the major banks, they've got a lot of pressure from the government to pass on the discount.
Mm-hmm.
And so we'll know that hopefully in the next coming days. The banks tend to put that off, sometimes a week or two before they announce their cuts. But there are a couple of banks already, actually dropping their rates.
Yep.
I guess the other good news is APRA.
Yes.
APRA reducing their benchmark lending.
Yep.
And that came out about 2 weeks ago from 7.25, and they're saying from your standard variable rate to allow about 2% maybe a variance.
Yep.
The positive thing to note on that is, to a borrower or an investor, that's an automatic increase in borrowings of about 9%.
Mm-hmm.
And if the banks pass on, which I believe they will, pass on the rates, that's about a discount. That's about an extra borrowing capacity of about anywhere from 12 to 13%.
Yeah.
So really great news for investors that are limited with their borrowing capacity. Really great news for homeowners that are getting into the market. And even with the coalition obviously winning, they announced the first home buyers 95% lend, waiving LMI, which is lender's mortgage insurance.
Yep.
People have this perception actually that lender's mortgage insurance is designed to protect the consumer.
No, it protects the bank, and
that's why it's called lender's mortgage insurance, not consumer.
Definitely, and it's amazing that people don't understand. Even if you have LMI, then if you were to foreclose and the bank takes the house, then basically the insurance company will pay the bank out the difference, any losses, and then the insurance company is then going to come after you.
And what's amazing is it's only one of very few insurance policies that a consumer pays for, but the banks are covered, not the consumer.
Yeah. Maybe we should start off insurance that actually helps the consumer. That might be an idea.
Do we have a question here?
So no questions yet. Just great news after getting on board with us. So that's good news.
Thank you so much. Thank you very much.
So, and a quick question. So, what does APRA stand for?
Australian Regulation, AP, Australian Prudential Regulation Authority.
Correct. Yeah.
Yeah.
I didn't think you'd know that, but
that's what
a lot of people. So,
not that I'm a broker, but I guess we are.
Yeah.
We understand that.
Yeah. And I think for people to understand with APRA at the moment, with a lot of banks, what they say is, okay, the way that you calculate it, even if the interest rate is, say, what, 3.5%, 4% now, they say, okay, so what we're going to do is, or for the banks, the institutions, you need to measure borrowing on two things. So either if it's 2.25% above that, so if it's 3.5, then they'd work it on 5.75.
6%.
Yeah. Or 7%, whichever is higher. But some banks even have a bit of a buffer themselves and might charge it, do their assessments at 7.25 or 7.5 even.
Yeah.
So all this means is APRA is saying that, okay, there's no benchmark of 7%, and they're recommending 2.5%, which will mean the difference that if we've got an interest rate of 3.5%, it'll be borrowing, assessing it at, that'd be 6%.
Correct.
Which is a whole percent different. Even more in some cases,
Correct.
which is, and you said 9 to 10%.
Increase in borrowings.
Yeah, so if that's on a $500,000 mortgage, you're looking at $50,000 extra that you could borrow.
Correct.
Which is a huge amount. Also with the first homeowners, I think having the opportunity, so all it really means is that the government is going to back that. So if anything happens, the government will pay that to the banks.
But what people need to still understand, the servicing calculator still takes into play.
Yeah.
So obviously you're borrowing more, so you're going to need to be able to service that loan. You still have to pass the strict lending criteria, but it means that you don't. The reality means is you don't have to pay the LMI.
Yes. Yeah, and that's the best thing, because LMI is expensive. And it's
but just to note, which I'm not an accountant, but you can get this advice from your accountant. LMI on an investment property is actually tax deductible.
Okay.
Okay, and it's actually claimed over 5 years of the loan.
Oh, cool.
Okay.
Awesome.
Next question.
So I guess going through, I think you're going to do a few videos coming up over the next few weeks.
Yes.
But I think the main thing that we want to help people with is not just what to do, but what not to do. And I think even working with you for so long, you've taught me certain mistakes of just even goals, like planning. So a lot of people don't plan what they want to do. So let's go through the 5 mistakes of what people would with investing.
Well, I'll go through a couple of them.
Okay.
That's going to be my series, and then I won't watch it.
Okay.
So I guess the first thing I say, the reality is people don't plan to fail, but they fail to plan. Majority of the successful people I know out there understand they have a clear vision of what they want in life. They have a clear target, a clear goal, and they put a plan in place. And the best way I could probably explain that is, if you were to build a house, you don't just rock up to the site and go, let's lay the slab and figure out the walls later on. Go to an architect, design the house, make sure you know where the rooms and the bathrooms and the kitchens are. But most people don't have that plan. And the sad reality, I think it starts when we're younger.
Yes.
And the reason why I say that is because we're not taught in school how to manage our finances or even how to set goals in life. In school, your parents teach you, your parents tell you, get a good education, son, do really well at school, then get a good job, or they say a secure job. And the reality is today, there is really no secure job out there.
No.
And I've been brought up, well, I haven't been brought up, but when I got into the working industry, I was very blessed to have someone that really taught me a lot about money. But he said, a job, J-O-B, a job will keep you just over broke. Remember that? Yeah. So, it's that mindset to get a job, work 50 years, work hard, pay 50 years worth of your taxes, and then just to hope that the government be around to support you. We're taught as a kid debt is bad, and I'll show you a video that comes up in the future that talks a bit about where my parents had an opportunity to buy a home, and they never took that opportunity, and that development now, that house now is being sold. The three lots have actually been sold, and that house got sold for $750,000 when my parents had 20 years ago the opportunity to buy it for $70,000. And the reason why they didn't buy it is because they had that mentality that debt was bad, and also the fact that pay down your debt first. Don't invest in nothing until you pay down the debt. And a lot of Australians out there have that belief that you buy a home, pay down your mortgage, and then if you've got anything left over, then consider investing. But the problem is, the time you pay down your home, you're looking at 20 to 30 years, and then the market has increased 3 to 4 times, and then you've only got 15 years left in the workforce to start investing in your retirement. And that's the reason why 78% of people in Australia end up relying on the government for assistance.
Yeah.
And it's a sad reality. And the saying goes, 95% of people will just survive, 5% will stay wealthy. Why is it always 5%? It's because the 5% teach their children how to make money.
Yeah.
85% of people rely on the educational system to teach them how to make money, or their parents.
Yeah. Or their parents teach them how to spend money.
Well, the sad thing is my parents have given me a lot of advice in my life, but financial advice is something that I've never taken from my family because they've never been financially savvy. And that's probably in some of the series of mistakes going to, mistake 2 for people is basically, making sure who you don't take advice from the wrong people.
Yeah.
I have this saying, like, if you were to go learn how to swim, you don't go to a professional runner.
Yeah.
If you're going to learn how to play tennis, you don't go to a cricket player. Okay, so if you're going to learn how to make money, the problem with most people, they rely on the people that are close to their heart for advice.
Yeah.
Like their parents, their friends, their co-workers. And the issue that you have there when you rely on them is majority of the people out there will give you all the advice in the world, but very few follow it themselves.
Yeah.
So my question to you is, if you're going to take advice from your parents or your friends or your family, ask yourself this question: are they financially in a position where you want to be in 10, 20, 30 years?
Yeah.
Now, if the answer is yes, and it's the path you choose to take, because they may have a career that's given them a different path to achieve that. But if it's a path that they decide to take, then make sure you follow that path. But if it's not, then maybe it's not the best advice. Listen to your parents about being good, being humble, being grateful, but I think be very careful. And and the other thing I would say too is, even companies out there that portray to be similar to what we do. You have all these so-called professionals out there that say, we've been in the industry for 20, 30 years. And my question is ask them for their qualifications.
Yeah.
We've got qualified real estate license. We're fully qualified. We've got fully qualified financial planning company. We're fully qualified brokers. We've got we diplomas in finance. So we're qualified in the fields. In actual fact, our company has been established, for 20 years. Now, do your searches. Go to ASIC, go to Department of Fair Trading, and do your background searches on companies that proclaim that this is what they do. The other thing I'd consider is there an invested interest, in the products or services that you offer?
Yes.
And are they selling their own stock? In actual fact, we don't own anything. We source the property on behalf of our clients. So I just recommend people do searches, do background checks, just to make sure you're making that right decision.
Yeah, and I think one thing to touch on when you're talking about, a lot of people might go to advice from their parents and close family and friends, and you trust them, but the problem is that they might not want to see you get hurt. So they might say, don't do this or don't do that, because maybe they've been hurt in the past, or they haven't been able to succeed where you might be able to. And it's that fear of the unknown or being hurt that they tell you not to do something. But at the end of the day, you lose out on those opportunities, and you only live life once, and you have a few opportunities that you really want to take advantage of. And the last thing you want to do is reach the end of your life and have all these regrets. I should have done this, I should have done that, and not done it, and then you're the one that's in the position that you're in.
Totally agree.
Yeah.
I totally agree. Do we have any questions? I have a few people on there.
Yeah, so Chris has got a question. So for someone that's looking to start property using a self-managed super fund.
Yes. So
what advice can you give for someone looking to start
property? I can't give advice because I'm not the financial planner, but I've actually put out a few videos that are coming out very shortly with our financial planner to give that advice. There are definitely pros and cons towards setting up an SMSF or purchasing a property.
Yes.
This is just for educational purposes, so don't take me on this. As I said, you need to seek financial advice, and we can organise that to discuss that based on your circumstances. And an SMSF is not right for everybody. The reality is a self-managed super fund, requires a lot of work in the background. You are responsible for that fund to manage that fund. It gets audited each year. The benefits of owning a property in a self-managed super fund, for me, I think are great. If you're going to buy a commercial property, you can run your business from it.
Okay.
And the business pays for the fund. Another great thing about having a property in SMSF is it's the asset at retirement is tax free.
Yeah.
Even if you sell before retirement and you sell within 12 months, the marginal tax rate is like 10% or so, and so the tax rate is a lot less than if you were to sell outside. And there are disadvantages too. You can't sell the asset and go on a holiday. It has to stay in the fund, and it's not something that I want to answer too much because I can't give you that advice, Chris. But if it's something that you are interested in, we can definitely organise, our financial advisor to discuss that further with you.
And do you think you can say what sort of amount in super you'd need to get started with?
No, I can't.
Okay.
But on average, our clients in the past have been able to invest as long as they've got a minimum of around $200,000 to start off with, and an income to be able to service the loan. The loan. It's a great thing having a property in super. It also doesn't affect your disposable income because your employee contributions and the rent actually pay down the investment. So there are a few benefits there.
Definitely. And just a general question, I guess. So with everything that's happened, you've got the RBA cutting its rates. You've got the APRA loosening or trying to loosen the assessment for new loans. What do you see with the property market? Where do you think it's going to be heading?
I've always said I don't have a crystal ball, but what I can tell you is the facts that currently stand at the moment. So auction clearance rates since the coalition has won, it's gone up again from last week, from the previous week. Confidence in the market is definitely increased. We can see investors back into the market. We can see the amount of listings in the market have doubled, minimum doubled over the last couple of weeks. Is there we can tell that, well, actually, last month was the lowest drop in declining property prices than it's been in the last 12 months. So 0.4% of a drop in Sydney, roughly the same in Melbourne, less in Brisbane and certain things like that. So we can clearly see the market coming to an end in regards to falls. Do I still predict the market to continue to fall? Some markets will continue to fall. Some markets are stabilizing. No market is working at the same time, if that makes sense. For the future, I've always believed the property market, runs through its cycles. Back in 2003, the market did between 1996 and 2002, market did very well, performed quite well. 2003, the market dropped and then stabilized for like 9-10 years, and then from 2012 it started to pick back up. I'm referring to mainly Sydney here because we're based in Sydney. I'm referring to that, but different markets did work at different times, and it's just going through its generic cycle. Do I think now is the best time to invest? I always think it's not necessarily timing, but time in the market, because no one has a crystal ball. But what I can say is good indications. How do we determine the market is starting to improve? Look at days on the market. Days on the market is one of the most important things to consider when investing. If the days on the market is sitting around 35 to 40 days or 35, it's a moving market. We can still see Sydney sitting around 50 days or so, but clearance rates are starting to increase. So good signs. If you think it's a quick rich get rich quick scheme, where you're going to make money in the next 2-3 years in the Sydney market, the Melbourne market, see other opportunities better than the Sydney and the Melbourne market for a number of reasons. But there is definitely good opportunity out there. Low interest rates, low servicing or better servicing at the moment. Markets down with pricing at the moment. Like, I personally don't think there's no better. Warren Buffett said this, and I've always believed in it. He said when the market is doing great, he says don't invest. When the market's doing slow, it is the time to invest. When everyone's buying, that's not the time to buy. That's when no one's buying. It's like cars. Cars go on sale when you get all these great deals at the end of the financial year, because no one wants that particular car. So that's the ones that go on sale. So hope that answered your question.
Yes, definitely.
It was?
Oh, that was just a general
question. General. There you go.
So, now, I guess, looking at other companies like us, certain ones, they might have a magic formula of how we're going to be able to help people make all this money and everything else. Now, obviously, we know that we've been brought up that if it sounds too good to be true, it is, or it normally is. And we don't talk about, as you said, get rich quick schemes. We wish we had some, that'd be awesome, but they don't really exist. but we show people ways that they can invest in themselves and build themselves up and create wealth when they do come to the stages of retirement, and they don't have to rely on the government pension and things like that. So what is RPA's formula? How do we help customers achieve their goals and get to the stage where they can live comfortably?
Okay. Well, I think it starts with identifying exactly what the potential investor is trying to achieve. Some people say, what is financial independence? And for one person, it may be to be able to retire on $30,000 or $40,000 a year because that's their expenses.
Yes.
So for others, it may be $100,000, $200,000, $300,000 a year. Some others $1 million a year. And my definition, I'd say what financial independence is, or being able to be financially independent, is having your asset base to be able to produce enough income that you no longer need to work. So what is our strategy? It all depends on what the client's goals and objectives are, but we're not just property.
No.
People have this perception that we just do property. In actual fact, I would say 40% of our business relates to property. A lot of it relates to money management. We've developed a software over the years that not many companies have.
No.
And it enables people to control their finances more effectively, because the problem is most people are struggling to set themselves up financially. And the reason why they struggle to set themselves up financially is because they don't understand their finances today.
No.
Where do they stand? What's their cash flow position? Do they maintain a written budget? Do they have a savings plan? We help put that strategy in place. We also have financial planners that help assist with that. And then we determine their finance and their borrowing capacity and what strategy they're comfortable with. We aim for growth in the first phase. So the first phase is about growth, because you're never going to get financially wealthy just on cash flow. People have this perception that cash flow is king, but the problem is cash flow has very little growth. That's the reason why it's positive cash flow. That you tend to find more in regional areas. I was looking on Facebook the other day and I saw these other marketing companies come up saying, buy these $300,000, $250,000 homes, $300,000 homes, and these are in growth areas. Well, when I looked at the houses, they've been there for 20 years. And if it's in a growth area, you'd expect it to be worth a little bit more than $300,000 or $250,000. So I have this philosophy: always stay within 30 Ks from a capital CBD, even closer if possible. But once again, it depends on the client's borrowing capacity and strategy.
Okay, cool. So you'd say stay within 20-30 kilometers of capital CBD.
Maximum. Maximum.
Now, and also you're saying, so when it comes to cash flow, positive, negative, you'd prefer.
Well, we try to structure it. Negative is not the key objective. The reality is, if you're buying in a growth area, the chances are that the rental yields are going to be slightly less. So we aim to get properties that are more neutral, but there may be an element of negative. But you'll have potential growth, a higher potential growth in these areas than you would in areas that are producing $100 cash flow a week.
So, and for people that might, because I've had this question quite a bit, where if you say have a property and it is negatively geared, so obviously there are benefits with properties where you can claim depreciation on the property and the fittings and everything else, and then you can get that back in your tax. So does someone have to pay out the shortfall every single week, and then at the end of the year they get the money back to be able to reimburse them? How does that work?
So obviously, if you've bought a property that's negatively geared, regardless if it's negative or not, you're still entitled to the depreciation, depending on how old the asset is, if it's an established asset or investment. So new property, you can claim 2.5% over 40 years. Fixtures and fittings are over the lifespan. And I guess from a cash flow perspective, if the property does become negative, the losses can be claimed or offset on your taxable income. Now, people can do two things. They can pay the shortfall out of their own pocket until the end of the year, make sure they have their depreciation schedule done by a quantity surveyor, and they're able to claim that lump sum as a whole. Or the other option is, if you get paid on a weekly, fortnightly, monthly basis, you can apply for what we call a tax variation, which means instead of getting the money as a lump sum at the end of the year, You can actually get it through the pay cycle basis.
Okay.
And so you can use that to pay, sit your offset account and pay towards your investment.
Mm-hmm.
It depends on your cash flow position. In actual fact, a lot of our clients say, well, if I could pay the shortfall, it's forced savings.
Yep.
And then when it comes to tax time, they get the $8,000 to $12,000 back. That's their holiday money or something else they choose to use it for. Some people need the variation to fund the cash flow, and that was probably one of the biggest things that the coalition was really pushing, the importance of the negative gearing perspective.
Yes, definitely, because especially having that sort of money, if you have to pay it out and then get it back at the end of the year, that can be very hard for some people.
Well, they were taking that completely away, and the sad reality is 80% of Australians that invest rely on negative gearing.
Yeah. And if that happened,
it's all done.
So, and I guess you were touching on before, so when you come to retirement, the sort of income that you'd need. Now, obviously, different people need different incomes. With ASPA, so it's the Association of Superannuation Funds in Australia. So with them, they say that just a modest income as a couple in retirement is about $39,000. And then
think about $39,000 for a second. I asked the question is, could you survive on $39,000? Well, you probably could survive.
Yeah.
But do we work 50 years to get to retirement?
Yeah.
And live off a modest income of $30,000?
Well, hopefully not.
But the sad reality is most people do.
Yeah.
The average super balance at the moment is $270,000. Like, if you were to live on $50,000 a year in 5-6 years, you run out of money.
Yeah.
What do? Go back to work?
Yeah. And I think it comes down to people look at your lifestyle at the moment. If it changed today and you only had $39,000 income, and that's as a couple, is that something that you'd be able to survive with? And you'd have to find ways to make it happen if it was a reality. And when it is a reality and you're at the stage of life where you can't, or you probably don't want to find a job and go back to work and have to live off that, that can be very daunting.
Well, I say, the one thing that we can never make, we can always make money.
Yeah.
But we can never get back time.
No.
And the longer we leave it, the harder it is.
Yeah.
Our number one client is clients between the age of 45 and 55.
Yeah.
Because the realization that, oh my God, I don't have much time left.
Yeah. And the hardest factor there is if they don't have much time left and they haven't done anything to do anything about it, when you're right at the end of that time and you're going to want to retire in the next 5, 10, 15 years and you haven't done anything about it, it's the worst time because you haven't got that time to be able to build it up, especially when you're looking at investments. It's not a short-term thing.
Yeah.
And I think that comes down to, as well, as you were saying, and as you always say, that people don't plan to fail, but they just fail to plan.
People plan their vacation or holiday better than they plan their retirement. And then I used to say, well, it's probably because it's easier to escape reality than face reality.
Of course. And so I think we've only got a couple of minutes left. So I think maybe the last question should be, why do so many Australians invest in property over other things?
The only thing I can say is, the facts are there's $7.2 trillion being invested in residential real estate. There's about 1.7 trillion in commercial.
Yep. It
is the number one chosen asset. We've always grown up, the Australian dream is to own your own home.
Yep.
It used to be the quarter-acre block, okay, but that is diminishing.
Yep.
To own your own home, go on a few holidays, get to retirement, enjoy your life. But I think it's something that you can touch, we can feel. We know the history.
Yeah.
It shows in the past 80 years on average, the property market has doubled on average every 7.5 years.
Yep.
I know what some of you are thinking out there. No, it hasn't. Well, when they say 7.5 years, they refer to a capital region, a city region within 30 k's of the capital CBD.
Yeah.
So country towns, probably not. And that's not something that we would recommend.
No.
In actual fact, the last 2 cycles have taken about 12 years.
Yeah.
But I always say, well, if you bought a property for $500,000 today and it's worth $1 million in 15 years, not even 12 years, when was the last time you've saved $500,000 in 15 years? ask yourself this question. You've worked now for maybe 10, 20, 30 years. Have you saved $500,000?
Yeah.
Most people will say no.
I think nearly everybody would have to say no to that.
Yeah.
So, yeah. Well, I think that's all the time that we got today for this.
Okay.
Yeah, I think we've gone through a lot of questions. And guys, I think we get a lot of questions every week. If you've got anything, then send it through. You can message us on Facebook or send us an email at info@residentialinvestment.com.au or give us a call, 1300 989 542.
Or you can shoot us one live when we're live and put us on the spot. So there's no preparation. But no, I'd like to honestly thank you so much. If you're interested in the free discovery session, happy, reach out. Would love to connect with you guys. And until next week,
yeah,
take care. God bless, and we'll talk soon.
See you later. Bye.
See you later. Thank you very much.